Most business owners choose Roth or pre-tax based on what they heard, not on what actually leaves them with more money in their pocket. In this video, you will see exactly when Roth wins, when pre-tax wins, and how to tell which one is more likely to leave you with more after-tax money in your situation. Let's ignore the hype, ignore the slogans, and just run the numbers. Most people are told some version of, if you expect taxes to be higher in the future, choose Roth. If you expect them to be lower, choose pre-tax. That sounds simple, but the option with the lower tax rate today does not always win once you look at the full picture, including contribution size, growth, and what actually gets taxed later. To make this concrete, imagine you put money into a pre-tax account, it grows, and you pay tax when you pull it out, versus putting money into a Roth, paying the tax now, and never paying tax on that money again. If your tax rate is exactly the same now, and in retirement, the math can leave you in almost the same place after tax, which means the slogan alone is not enough to make a good decision. So instead of arguing about which is better, let's walk through 3 real scenarios and see where the more money actually shows up. Before the scenarios, here are the ground rules so you can follow the math. We will assume the same investments in both accounts, the same growth rate over time, and the same contribution schedule. The only things that change are your income level and your tax rate now versus later. All we care about is one question. After all the taxes are paid, which path leaves you with more spendable money at the end? First, let's look at a moderate income year. Say you are in a middle tax bracket today and you expect to be in a slightly lower bracket in retirement. Nothing dramatic, just a step down. On the pre-tax side, every dollar you contribute today avoids tax now and grows tax deferred. In retirement, you pay income tax on withdrawals at your future rate. On the Roth side, you pay tax on that dollar now, contribute what is left, and then all the growth and withdrawals are tax-free later, as long as you meet the usual rules. If today's tax rate and your retirement tax rate are fairly close, the after-tax outcome between Roth and pre-tax can end up surprisingly similar, especially if you invest consistently over time. In this kind of moderate income, slightly lower later scenario, pre-tax can tilt slightly in your favor because you are taking the deduction at a somewhat higher rate and paying tax later at a somewhat lower rate. The key takeaway is that in a typical moderate income career where retirement is a bit cheaper tax-wise, pre-tax contributions can quietly edge out Roth in pure after-tax dollars, even though Roth feels more exciting. Now let's look at a high-income year where your current tax bracket is much higher than what you realistically expect in retirement. Think about a year with a big bonus, a business windfall, or unusually high profits that push you into the top brackets. In that year, every pre-tax dollar you contribute avoids tax at that high marginal rate, which means you reduce your current tax bill more and you get more money working for you inside the account for the same out-of-pocket cost. Later, if your retirement tax rate is meaningfully lower, you are paying tax on those withdrawals at a cheaper rate than the deduction you took up front. When you run the numbers in this type of high income now, lower income later scenario, pre-tax very often leaves you with more after-tax money than Roth, precisely because the deduction today is so valuable. This is the moment where defaulting to Roth is always better, can cost you real money because you are passing up a large tax break at a very high rate. Finally, let's look at the opposite problem, the years around exit or retirement. Imagine you have already built up a large pre-tax balance, even without new contributions. Compound growth alone can turn a few $100,000 into a 7-figure balance. When you retire and start pulling from that account, those withdrawals stack on top of Social Security, pensions, or business income, and every extra dollar can be taxed at your marginal rate on that slice of income. If you push too much into pre-tax late in your career, you can create a tax wall in retirement where required withdrawals and other income push you into higher brackets than you expected. In this kind of scenario, deliberately building a Roth bucket in lower income years or before your accounts get too large can protect you from unexpectedly high future tax rates. Roth gives you a pool of money you can tap without adding to your taxable income, which can help you manage which bracket you actually land in each year of retirement. The key takeaway is that when you are staring at large future withdrawals, Roth is less about beating pre-tax in a simple spreadsheet and more about giving you a way to control and smooth your tax bill later. Roth feels good because the trade-off is emotionally clean. You pay tax now, label the account tax-free forever, and never have to worry about future tax bills on that money. Psychologically, that certainty is powerful, especially when you are anxious about future tax law changes or rising tax rates. Because Roth withdrawals do not show up as taxable income when the rules are met, it is easy to think of Roth as the smart or safe choice, even when the math is not always better. Pre-tax, on the other hand, often wins in the short term because it gives you an immediate tax deduction and reduces the hit to your take-home pay. For the same hit to your paycheck, you can often get more dollars into a pre-tax account than into a Roth account, simply because the government is effectively subsidizing part of your contribution today through the tax break. When your current tax rate is high and your expected future tax rate is moderate or low, that combination of bigger contributions and cheaper future withdrawals is exactly what creates a pre-tax advantage. The problem is that most people do not run any of these numbers. They just default to whichever option sounds better in a headline or was mentioned last by a friend, an advisor, or a social media video. If you consistently choose Roth when your current tax rate is very high, or consistently choose pre-tax when your current rate is very low and likely to rise, you can give up tens or hundreds of thousands of dollars over a full career. This is not about ideology or Team Roth versus Team Pre-tax. It is about matching when you pay tax to when it is cheapest for you. Here's the honest verdict. There is no universally better choice between Roth and pre-tax. There is only the choice that is more likely to leave you with more after-tax money in your specific situation. As a simple rule of thumb, if your tax rate today is clearly higher than what you reasonably expect in retirement, pre-tax usually tilts in your favor. If your tax rate today is clearly lower than what you expect later because of growth, future income, or expected tax increases, Roth usually tilts in your favor. The next step is not to memorize rules, it is to run your own numbers. Take 60 seconds after this video and write down your current marginal tax bracket and a realistic estimate of your retirement bracket based on your income, savings, and where you plan to live. Then match yourself to one of the 3 scenarios from this video and ask, am I paying tax at the right time, or am I donating extra to the IRS out of habit? If you want to see how this decision interacts with everything else, like Social Security, selling a business, or timing big withdrawals, watch the video on your screen now, where the numbers get applied to an actual retirement tax plan. And in the comments, drop Roth or pre-tax, plus your age and your current bracket. A future video will break down the most common combinations and what the math actually looks like for each.